The SME market is a substantial market within Australia. So SMEs are defined as a business with sub 200 employees, according to the ABS. They employ just under 70% of the Australian workforce, so they're a significant contributor to the Australian economy as a whole. And we have been seeing that their access to funding from bank sources in particular has been dropping in recent times. So we see a huge opportunity to come in and provide funding to fill that funding gap that the banks have left. Judo Bank published a report back in August 2019 that outlined a $93 billion funding gap for Australian small businesses. So that market opportunity is substantial, and what is needed to fill that gap is obviously private credit for the lenders to on-lend into the Australian businesses. Banks have tended to push more towards property-backed security and have really skewed their portfolio more towards residential mortgages. So what we're seeing is for every dollar that's deployed by the banks into residential mortgages, they're putting approximately 25 cents into business lending, which has been a substantial drop. The other thing in the business lending space, for loans over $2 million, we've seen substantial growth from the banks. So from 2011 to today, we've seen about a 50% increase in loans over $2 million. But we've basically seen about a 10% increase in loans under $2 million. So we are seeing that the banks are really focusing on those loans that are larger, and it's primarily due to their legacy systems there, where it costs them more money to originate and service a loan over the life of that loan, whereas the more tech-enabled businesses and tech-enabled lenders are able to do it at a much lower fixed cost, which will obviously lead to them looking at those smaller value loans where they can still add value. I think it really goes back to our background in venture capital where it does help. So obviously tech-enabled business lenders are an emerging category of lender. So we do take Aura's venture capital background and provide that VC overlay when assessing an originator. Then we take a more traditional approach to credit assessment, looking at how lenders deploy that capital. How do they assess a borrower? How do they assess a business? How do they assess that they will get that capital back in the door? So it's a two-pronged approach that a lot of credit houses won't have.